Good afternoon and welcome to Freight Forecasting. I'm Mike Vincent, Freight Forecaster here at FreightWaves, and joining me again is my good friend Anthony Smith.
Hello, hello.
Lead economist here and market expert as well at FreightWaves.
Host of FreightWaves Now.
Host of FreightWaves Now. That's right, Mr. Energy. So freight forecasting, disparate data, analytics tools, what you need to freight forecast, especially in these difficult times here, obviously, to figure out what is going on. Is the trend going to sustain on the upward? Is it going to be a series of W's, as Lawrence Alvarado said, or is it going to be a swoosh recovery, or is it just going to tank tomorrow? All these different things. We got all these different disparate data sources that you can't, you've got to be able to have the ability to not only ingest this data, but also then interpret it.
Right.
And then on top of that, my latest argument that I'm starting to throw out there is you've got to have that human element, that interpretation, that market expert, that human sentiment involved to interpret what those signals mean, right?
Yeah, that's correct. And I mean, that's really what the basis of FreightWaves is, right? When we're looking at FreightWaves, you can have all of the data, you can have all this information, but if you don't have any way to dissect it, define it, really tell you what it means, all that tribal knowledge that really kind of puts things into perspective, it's meaningless. I mean, you can set up a model, but if you don't have someone that's been in the industry that knows what's going on to explain certain spikes, maybe certain things that are out of the norm, certain seasonalities, things like that, that's where, there can be a little bit of hiccup. So it's like you said, it's key. You have to pull all these things together, have all this perspective, and then also make sure that you are doing your due diligence by really testing all the weaknesses from all different aspects by industry experts.
Yeah, absolutely. And if you're a company that has that bandwidth, that intelligence bandwidth within that company, good for you. Most don't.
Right. Right. Yeah.
And so you need something that can do that. And like you said, just through the SONAR platform, you can do all that type of stuff.
Exactly.
You've got the data, you've got the daily data, you got the real-time data, you've got the analytics tools, but then you've got also the news feeds, you've got the research coming through, you've got the ability to get involved with Passport that is even more exclusive and deeper dive research. I believe you have a monthly paper coming out.
Yeah, I have my monthly SONAR market update that I do with Zach Strickland and a few others, Mike Bowdendistel and Henry Byers. But I think one of the other things is we can work with some people that you barely get along with, and you're not afraid to point at each other's arguments and think that, I don't know, I'm not on that bandwagon. This is my perspective,
Yeah.
And so you come at it from all different angles, and it's not just a bunch of people saying yes, yes, yes. It's
Exactly.
No, I think you're wrong, and here's why. And so that's really what helps refine the entire process.
It really does. It really does. It's the ability to that no holds barred banter.
Right,
I guess is what it is. But so let's go to the screen here because we've got some good new economic data that came out, and I'm going to start here with good old fashioned truck data, and then we'll get into we'll work our way to the ISM and LMI releases.
Excellent.
Right, and kind of go into those. But I want to just kind of go down the garden path of what is going on right now, because we are seeing this recovery. And right now on this screen here, you're seeing on the left-hand side, you've got the outbound tender volume index for all modes of over the road. And then on the right-hand side, you've got the outbound tender reject index, all modes. And in the center, you've got outbound tender rejects by mode. So you can see that we are on this uptick, right?
Yep.
And it looks great. Hey, we're back. But are we?
What's the full picture here?
If you change the perspective, we still got a little ways to go just to get to average of last year, which was not a great year.
Right.
Right. And then if you look at this and go over, I can change this display and change the seasonality and look at 2 years. Let me stretch this out a little bit here so you can see it a little bit better, and do full year so you can see where we're at. Kind of dig this in, and I can change this to full to I guess I should do a large fonts
Large
here, right?
font there.
Okay. We threw up the large font, and now I got to move this over a little bit, but that's okay. It's worth it. Trust me. Okay. So the question becomes, here's where we're at right here. There's today.
Right.
Okay, if we look at that, we're just about to hit last year's numbers, which were bad numbers, and we're crossing it at a time when last year's bad numbers were anonymously horrible numbers.
I think they call this in the industry easy comps. Some easy comps here coming up. Like just as you said, this was not a good period last year. So in comparison, we can hope to get to that level.
Yeah, and I'm not saying that this proves, hey, we're not recovering and it's not good. No, it is. We are. It is good. But what it's saying is, don't take your eye off the ball.
Yeah. Perspective.
Because it's going to be a bumpy ride.
Right.
And let's keep the perspective. You need to know where we are. And not only that, you need the experts as well. What happened right here? Well, right here, this was rebound from tweets. These were trade war tweets.
Yeah.
It killed this, and you don't see this dip. This was a geopolitical type of thing.
Right.
Or a geo tweet. I don't know how I would work tweeting into political, but
geotwitical.
But the point is, I mean, this was nothing even actually happened here. It was a fear of something happening.
Yeah.
That caused this to happen. So just another point, that human sentiment you've got to have on there, and perspective.
And that's not something that's going to be popping up in the models that
It's not going to be in your data models.
Yeah.
It is not going to be there. You've got to have that interpretation. And so let's move over here to the right hand side, and we'll keep moving. So. What this looked like was unbelievable. That looks great.
Yeah.
Where I had this, right?
Right.
But if we look at this from a year, it's not so great.
Exactly.
We're down here where rejections were really low all last year, and we had no upward pressure on truckload rates at all. And then if we take this and we move this one as well, and see, I actually had this one on the right one. Look where we're at.
Yeah.
And I can move this to full year as well.
That really tells a story.
That's what's going on.
Yeah.
So don't take your eye off the ball. You need the data. You need to be watching what's going on a daily basis, because there's what's going on. Now let's look at a couple other things here. If I open this up a little bit here, Anthony, and I bring this down to, and you can notice I'm going through my 5 most important dashboards.
Yeah. The top 5.
Isn't that interesting? If I come over here and I look at this is where I got my watchtower and my most volatile markets, right? So what I just did was showed basically these two items over here. Your outbound tender volume index, and then on the right hand side your rejects, right, year over year. To put some perspective on it, you can see that's this exact same curves. These are just slightly different graphs, and you can see where we're actually at. And if you look at these in different manners, you can see we're just coming out of a negative baseline over last year, right? And we're anyways. So we're looking at those, but I'm not saying that there's no opportunities out there, because if you look at this, now you've got your market table over here. You've got to be able to break down those individual markets, the economies, and if I'm talking about the economic impacts of the industries that are happening in Atlanta, that's not microeconomics, is it?
I mean, you start to get into microeconomics when you start looking at a little bit more granular.
Right?
Yeah, you get into microeconomics there. I mean, especially when you start to look at regional and industry-based.
Yeah.
But yeah, you kind of start to get in there, and you're exactly right. You have to start looking at what's driving.
Yeah, what is driving Atlanta for this head haul, and it's obviously reefer.
Yeah.
But what is it in the reefer? You've got to know what that data that in there for long-range planning. This is tactically. Turn this on, and I can come up over here into my toolboxes and hit these alerts, and I can throw up alerts that are going to make my telephone explode and my email explode every morning when something strange happens. I sit in those parameters, and I can see when O-Tri moves up, when volumes go up, if capacity tightens, and I know exactly where I need to focus as soon as I come in the office every day, whether I'm a carrier, a shipper, or a broker.
Right.
Right? But this is telling you what's going on, but then... So you can react to that, but look at here's Los Angeles. Everything is up.
Yeah.
Inbound, outbound, rejects, inbound, rejects, outbound. Haul index is up. Van, refrigerated. It is just on fire
Across the
right
board.
now, across the board. So this gives you that perspective. And then if we come down and we look at our move back up to this maritime one, the maritime origins, this one starts to get a little bit more into your boat a little bit more,
Yeah.
I think, right? So there's opportunities out there on a micro scale that we're looking at, and you got to look at those different markets and know what's happening in those markets. So you need that human intelligence, not just data. But then we look at something like this, and where I want to start is over here. Well, right here. Here's your weekly imports by industry. That doesn't look like it supports a very strong recovery.
Yeah, and especially when you're looking at segments that are primary drivers for many modes of freight in different equipment types. Manufacturing.
And what are those?
Manufacturing, huge one, especially when you're looking at flatbed. Non-durable goods, especially when you're looking at maybe van or reefer, depending on the shelf life.
So non-durable goods is more consumer-oriented?
It can be. I mean, so it could also be raw materials.
Oh, okay.
But
Okay,
it's anything that
Gotcha.
has a shelf life of 3 years or less.
Yeah.
But durable goods can also fall into a consumer segment. Retail trade, definitely a consumer segment,
Yep.
down 7.6%. And that's going to feed into dry van. And so looking
Computer
across
and
the board.
electronics is the only thing that's...
Yeah. Yeah.
It's the only thing that's moving. And then you look at it over here, U.S. Customs maritime imports into the United States. Right here in this upper right-hand corner, here's what I'm looking at. And so over here, 430. That I believe that's a day. I think Greg Miller might have been on that day.
Right.
Our lead was our senior editor for maritime.
Yeah.
Right on American
writer.
Shipper and FreightWaves.com. He was calling for Cliff.
Yeah.
Right, because we were talking about blank sailings, and I don't know if this was certainly a cliff, and then they hit it. Well, they hit the cliff about halfway down, bounced a little bit, and then fell the rest of the way down the cliff.
Right.
Hopefully, but it looks like it's still going down.
Yeah.
So that doesn't. That's not supporting a swoosh or a V-shaped recovery, is it?
Right. No.
Or
it's not.
you.
Yeah, I mean, it's showing that there's many different mindsets around this. It's like, right, when you think about shipments coming in, were these pre-corona shipments that are just now we're just now catching up to?
Right.
And the other aspect of it, of course, is demand. Or is there, what demand do we have? You know,
Well, and that was the thing when I was looking at these things, these imports going up, was okay. We're back, and people were talking about okay, trucking's going to keep up. I'm like, but what? There's nothing supporting this.
Right. Yeah.
Right?
Yeah.
And so you've got to have those insights from your lead economist
Yeah, I mean,
and other market experts.
When you're looking at this, it definitely shows that there isn't a lot of catalysts really pulling or pushing for a lot of volumes, especially when you're looking at this. Of course, things can change pretty quickly depending on what kind of manipulation, so to speak, is put in place, especially when you're looking at incentives, maybe kind of certain tax breaks or bailouts, things like that, to really kind of spur business activity.
Didn't China just give some type of break domestically, China, to try and support purchase of goods from the United States, which were promised in the first part of the
trade deal?
The trade deal, right? Because they're not meeting it, but I mean, their economy was shut down.
Right,
so,
right. That was one of the stipulations there.
Yeah, so they're trying to do that. That's a manipulation.
Right, and China can definitely do that a little bit more easily than the U.S. just because that country is set up so much differently. But we have a few more regulations in that.
Right, so you've got to know where that demand is, that what's driving these type of things, right?
Exactly.
So then if I look at this, and more blank sailings, 140 more blank sailings, I think Maersk announced yesterday morning through June, which means this trend that you're seeing on the left-hand side, this negatives, that's what they're thinking, and they would know,
right.
I would think. And so now we look at this, which is just a disaster. There we go. I mean, it was a disaster looking, but what I'm looking at is the pricing.
Yeah.
So 40-foot equivalent pricing, China to North America West and China to North America East, and you can see this is what they're trying to prevent. right here, this drop-off by reducing the blanking the sailings. They're trying to take capacity offline.
Right.
Is what they're trying to do. Which when, I think Greg Miller did an interview with the Port Authority in Oakland, and I forget the gentleman's name, but, it doesn't necessarily mean, it means larger ships less often.
Yeah.
So cycle times are tough, which further turns the choke on a recovery.
Right.
If capacity is not there and you have to wait later for smaller ships or large ships, it doesn't matter. If the cycle time slows down, it chokes.
Right.
Right? Because then you start getting new orders, which we're going to get into, but back orders start rising.
Yeah, I mean, if you're looking at, you got to look at the whole thing, like you said earlier. You got to look at the production, of course. That can be all fine and dandy, but if there's no new orders, if there's no backlogs, if there's no demand that you can prove out, it's all for naught, and then that really kind of is going to make this whole recovery that much more difficult.
Right. So we saw that spike, and now we're seeing trucking go up as people are getting ready for what's going on. Warehousing space is filling up and draining and filling up and going.
Right.
And then up here in the upper right-hand corner, I just switched this again because I got 3 across here. But here is import shipments into L.A. and then the outbound rails, the 40-foot international boxes coming out intermodal out of L.A. And you can see them follow each other. They're following the spike. Here's the spike. They're gone.
Yeah.
And that's what Mike Baudendistel will tell you. I mean, he covers the rail, and it's not looking good for the rail whatsoever. Capital expenditures, forget it.
Big time. And the thing is capital expenditures is already in a very weak position in 2019, or at least the latter half of 2019, and going into 2020.
They're already pretty weak.
Yeah.
Yeah. Absolutely. So let's jump in here. What I'm pulling up here, or attempting to pull up here, is so here's our meat and potatoes here that came out, right?
Right, yeah. Not too long ago, just a couple of weeks ago, we had the update for the ISM, Institute of Supply Management, or for Supply Management, Purchasing Managers Index. Of course, this is a very popular diffusion index, so meaning that it's a survey-based index. It's based around the number 50, so this is anything above 50 is indicative of expansion, specifically within the manufacturing economy. Anything below 50 is indicative of contraction within the manufacturing economy. And one of the things I love about this index is that, of course, it has correspondent feedbacks throughout different segments of the manufacturing industry, but it also has different components. So it has production, it has new orders, it has supplier deliveries, it has employment, it has backlog of orders, it has, I think I already mentioned supplier deliveries. And so it has a lot of granularity within it to kind of give a perspective of what's happening within manufacturing and helps tell that full story.
Yeah, it really does. So here's so this is what we had up on last time. If you bring my screen back up for the folks that are watching, or folk. For Anthony's mother.
Hi, Mom.
So we were here.
Yeah.
Right? When our last show.
Right.
And you were saying you thought that this would drop further.
Exactly. Yeah. And one of the things is because what do we see? We saw the breakout of supplier deliveries spiking, but we knew that wasn't going to be upheld enough because we knew new orders weren't coming in.
Yeah, exactly. Because we saw this on the LMI.
Yeah,
through the roof. But you knew that was just the preponomics. That was just
especially when we compare it to our outbound tender rejection index, because the great thing about that, updated on a near real-time basis, when we look at OTRI, we can look at capacity, we know what's happening. And so when you marry the two together, it tells a complete story.
Yeah, it does, because we were talking, it's going to go down. There's no doubt it was going to go this way. We saw this coming. We saw this coming probably before this even came out.
Oh, definitely. Yeah. And it helps confirm.
We knew this was happening.
Yeah, and that's the beautiful thing, that it helps confirm the story. And
it absolutely does. So are there any other points inside here? I've got them all pulled up here next to you. I can throw them up on a chart.
Definitely.
That we need to look at here. Anthony, in your opinion, you got anything in here that you want me to dig into?
Sure. So, of course, we have here displayed the overall index, which is at a 41.5. This is the lowest level in, I believe, 11 years. So we can pull up, I believe, is the new orders component,
That's
which
pretty
is
low.
Very low, yeah.
Well, I mean, I was going to say not in 11 years, but wait a minute, I'm looking back in 1980.
Yeah.
So that was pretty bad. So what else do you want to look at?
We can try to pull up the LMI. I'm sorry, let me see if I can pull.
Oh, you're going to grab it right there?
ISM. M new. And so this is going to pull up the new orders component, and that is, Mike, that dropped 15.51 points, and so it's now sitting at a 27.1. And so that is showing that the outlook for manufacturing is grim indeed, and we can pair.
So that I mean, this is telling us that as of 14 days ago,
yeah, no bueno.
That nobody was ordering anything new.
Yeah, it's really.
I mean, all right. So just take me back, just for perspective. Okay, we're sitting here. Let's go back. 12/29. It's sitting here, right?
Yeah.
Then you see this.
Yeah.
When you see that, let's say you verify that this is true.
Mm-hmm.
What does that mean to you as far as manufacturing movement? How long till you see something out of that?
Typically with new orders, depending on the segment, you can see anything from some month and a half to 2 months down the line.
Month and a half to 2 months down the line. So this here, if this had ticked up, you'd be saying, yeah, there's a good chance we're going to be fairly
within the next
a decent recovery
months,
by July-ish.
Yeah, maybe start to see something coming in production.
But it didn't. It dropped.
Yeah, and so we can actually.
So it dropped 40. Wow.
Yeah.
Yeah.
And I think we could probably do a comparison here. FO try. And this, of course, we can do dual display and.
Oh, nice. Nice. Yeah.
Of course, the handy dandy large fonts. But when we're looking at this, because we know that so much of flatbed activity is on the manufacturing side, that complete drop and the blue line, which is flatbed, really kind of coincides with our expectations with that new orders aspect as well. Of course, it's not only manufacturing that goes into flatbed. There's other goods, construction, building materials, things like that, that could cause some other variations. But seeing that complete drop there and that green line really kind of highlights, okay, there is something not going on on the manufacturing side.
Yeah.
And it really paints a grim picture, at least for the flatbed equipment type.
Wow. That's okay. Is there anything good that you saw?
I don't know about good, but
right. Less bad.
The supplier deliveries are up, so that kind of that's what's propping up the PMI somewhat.
I got you. But is that the one that's reverse?
Yep, that's
or inverse.
Yeah.
So that's not necessarily a good thing.
No, and that's up to
manufacturer
76.
supplier index is 76. Yeah. I mean, a 76 is worse than a 50.
Yeah,
right?
I mean, it's showing that's really indicative of the pull forward of a lot of stuff, and then it really starts to hit inventory levels because we have inventory data, which I believe is in the.
We got PMI. Manufacturing customers inventory.
Yeah, we have that, and we have overall inventories, which popped up 2.8 points, so it's still at a 49.7, so just teetering around that expansion contraction area
for inventory
levels, but it is increasing, so it is showing that inventory levels are rising. And
is that preparation?
It could be some prep, or it could just be lack of demand for some manufactured goods. As Mike Bondiso highlighted, a lot of companies are putting a stop on all their CapEx spending.
Yeah. So maybe there was some anticipation of things coming back online, brought some stuff in, and then wait a minute,
can't move.
The demand's not going to happen.
Right.
So now you've got this rise in inventory levels that are sitting there. Right.
Right. So that's going to be one to watch closely. It's just what's happening with inventories. I think that's going to be the next one to watch. We really highlighted new orders to kind of really show what's going to happen with production and shipments in the next few months. But I think when we're watching inventories, I'm going to be watching closer to see if that hits that 50 benchmark and starts to overflow, and if we have building inventories in warehouses.
Wow, unbelievable. Anything else in the ISM that stuck out to you that you want to cover real quick?
Not too much. I mean, of course, employment is awful.
Well, we did. We covered that in the coronavirus freight market update. So what was going on there for those that may have missed that?
Well, overall unemployment was, of course, horrific when we were looking at initial jobless claims. But there is an employment aspect as well and the PMI, and that is now standing at a 27.5. So,
oh yeah, okay, I got
well
you.
below the 50
So
threshold.
if I click on this, look, check this out, Anthony. Boom.
Yeah,
How slick is that?
yeah,
That's not looking good.
not at all. And so that really shows the drastic drop within the manufacturing
Well,
segment.
so
with
we've got
employment.
this data back to mid 2015.
Yeah, we might even have a little bit further potentially, but yeah, you can see that this is
That's awful.
even through the down times of 2019, it never got this bad, and so
It's tough to come back from that.
yeah,
I mean, we're talking about reduced capital expenditure, et cetera.
Right.
But when you're talking about manufacturing, you're talking about warehousing and all these type of stuff. The incentives to stay at home and not work are pretty strong right now.
very strong, very strong, especially
Not only financially,
yeah.
but you know,
If you can make yourself through that queue and get on those some of those claims, it's some people are going to be making more on the unemployment benefits than they were.
they
when
are, and
were
even
working.
those that are making maybe slightly less. Why would I risk going out when it's still,
Right.
you know, it's not proven that we can get out there and not have a resurgence, right?
And I think
Why
it
risk
was
that?
probably put in place like that on purpose in order to kind of really reel in some individuals from kind of trying to get out there, make sure people are somewhat comfortable.
Yeah.
And stay
so
inside.
so there's an unemployment, and this one here, this is another data set as opposed to the new jobless claims or the
Yeah.
continuous jobless claims, which you need to be looking at. But now
Right.
here's one that's specific to manufacturing industry.
Correct.
And this doesn't make it look. There's nothing here that's going to make me think, oh my gosh, well, yeah, strong recovery.
Yeah,
Let's
there's
roll.
going to need to be some kind of incentives put in place
Yeah.
for this one to come
What
back.
about on the logistics manager, the LMI side of it? Is there anything in here that stuck out to you?
Yes, and so I love the LMI. Shout outs to Zach Rogers and Dale Rogers and the LMI crew.
Yeah.
With the LMI, so it's going to differ a little bit from the PMI. PMI is going to look a lot at the manufacturing.
Right.
LMI looks at the complete industry. And so we're looking at the LMI, we're looking at manufacturing and consumer side. So a little bit more downstream on some aspects. And
Yeah.
so LMI, similar to the PMI, wherein above 50 is indicative of expansion, below 50 indicative of contraction. This is at now 51.3, so this is the lowest level ever for the PMI.
And that's off of that, like we said before.
that spike
We were
that
saying this
saw.
spike over here was exact opposite of what was going on, but that was the preponomics. That was
Right.
all the movement of everything that people.
Right.
It was a anomalous demand.
Exactly,
Yeah.
exactly. And one of the things that we saw that really dropped pretty significantly was the LMI transportation prices component. And so we can pull that up here, and we can see that dropped, I think it was 27.9, so 28-ish points. And of course, we can pull up our OTRI in comparison. And let's do a dual.
Yeah.
And that really helps tell the story right there, is that there was a significant decline in the pricing for transportation prices, and also a significant decline in the capacity. I mean, LMI also tracks capacity, so transportation capacity spiked, so showing that there is an influx of capacity to
Unbelievable.
62.19 from, and that's a 15-point gain. So it's really helping confirm the story of what we're seeing of and a lot of capacity on the market. Transportation prices are low. They also have a warehousing component breakout that shows that the utilization index component increase. So really showing that there is a lot more utilization for warehouses right now. It's sitting at a 60.7. So there is a lot going in and churning in these warehouses, just sitting there.
Not coming back out.
Yeah.
That's not good. And so we're almost out of time here. And really quickly, so Fortune 500 CEOs.
Yeah.
Right? So pre-economic recovery, return to pre-COVID, 14% not till 2021, 58% not till 2022.
Yeah.
Right, capital expenditures exceed 2019. It's 81%, not till sometime late next year.
Right. Grim
That
outlook.
doesn't bode well. That's
Right.
bad.
Right.
I think that does it for today. So.
On that note.
On that note, thank you for watching, Anthony. Always a pleasure.
Thanks for having me.
Everybody out there, until next time, Thursdays, 4 p.m. Eastern Time. Peace and love.